This is the Debunking Economics Podcast with Steve Keen and Phil Dobbie.
The Archives.
Episode 241. Who were the bad guys in the Redditt Wall Street Rebellion?
Well, there's been a bit of argy-bargy on the share markets in America over this last week when a bunch of day traders set to take on Wall Street, particularly the hedge funds who were shorting stock on Gamestop, amongst others. Well, for a day or two, it created uncertainty across the broader share market, but it didn't take long for things to bounce back. So was there anything wrong with what they did or how the Robinhood retail platform responded when they stopped any more buying of shares? Who were the good guys and the bad guys in the Redditt Rebellion? I'm Phil Dobbie, and we'll look at that today on the Debunking Economics Podcast with Professor Steve Keen. Welcome along. So what about this Reddit forum taking on the hedge funds, the Wall Street Bets forum on Reddit, which has gone from, incidentally, 1.5 million followers to 5 million in pretty short order, and they drove up the price of GameStop shares, which had been around $88 to $470 in just a couple of days, and then it fell to around $300. I think it's still quite a bit more than that original $88 value, so it stayed overvalued, you'd have to assume. Maybe time for a bit more short selling to go on. So can you beat Wall Street, and should you, is the question we're asking you today. Steve, we spoke about short selling a long time ago on this podcast, and you actually defended it. You said it was actually, you thought it was good for price discovery because it brings overvalued stocks back to where they probably should be. So do you still hold that view?
No, I mean, I've got a slight sympathy for short selling. I don't see them as, people who should be exterminated, which is the attitude that some market commentators and some share owners as well, of course, have towards short sellers. But to me, what I should want happening on the stock market is raising new capital for new ventures, and that's the last thing that actually happens with the market at the moment. And the short selling is just a correction for the well, not even a correction. It's a battleground between the bulls and bears over different stocks.
Yeah.
And it's moderately useful, but it'd be far more useful if we abolished the whole, or not abolished the whole bloody lot, but made the secondary market secondary to the primary market, when the primary market barely even gets a breath on Wall Street days in terms of raising capital for new ventures. Yeah,
absolutely. And we've spoken about that a lot, haven't we, as well? You know, that people feel like they are helping a company. In fact, on that bulletin board, I read one comment from someone saying, that the hedge funds are bringing down the value of these companies, and that is meaning lots of people in those companies will be out of work, which of course is not the case because it's a secondary market. It's going to make no difference whatsoever to GameStop.
Absolutely irrelevant unless they've got some of their own shares they can sell back into the market. Yeah, and it's all one speculator fighting against another speculator. And what I like about it is it makes a total mockery of the way that neoclassical economists look at the market, because it's one of my favourite pieces of delusional bullshit and the history of economics is this quote from William Sharpe, who gave us the capital assets pricing model that says that effectively markets are efficient. Markets find the right price for everything. And he built this typical neoclassical, moderately elaborate model of an individual investor who had preferences for returns, which of course is a good, but against risk, which is a bad, and therefore you put your indifference curve between the two goods in a different shape to you when you look at apples versus oranges. And then he had an idea of a risk-free asset as well that you could buy, and then you could have leverage or not have leverage, yada, yada, yada. Great model of one person. Then he had to extend it to the entire economy, and he said, I will assume, quote, from this point on, homogeneity of investor expectations. Investors are assumed to agree on the prospects of various investments, the expected values, standard deviations, and correlation coefficients described in part 2, end quote. In other words, he fantasizes that the entire Reddit thing is impossible because everybody agrees with everybody else and there's no price arbitrage whatsoever, which is complete utter crap. And it's wonderful to see this particular episode showing what actually goes on stock markets, but making it accessible to the public as well.
But I'm sure, a lot of people would say, well, okay, this is fine. All it's doing is demonstrating the market working, and it doesn't really matter who's buying and who's selling, whether it's Wall Street or whether it's Reddit goers, Reddit forum subscribers having a go. They are correcting a market imbalance. GameStop shares probably were too high. They certainly were after this episode. But I mean, if you look at the share price generally in the US, I mean, the market is overvalued, surely. So it has to be brought back down somehow.
But this was actually going the opposite direction.
Exactly. Yeah, because they were taking on the short sellers. Exactly. But could say, well, the short sellers, which I think is sort of my point, the short sellers are actually doing some good. They were trying to bring the values back down again.
Yeah, well, I mean, what they were looking at was a company which was losing money. I mean, it's what's it called? Gamestop. Yeah. Interesting combination rather than Game Shop, Gamestop. And it was literally starting to stop because for a start it was going down anyway because people were buying their games online. So you didn't actually need a physical retailer to go to unless you wanted to buy extra little R2D2 widgets to put around.
Not entirely sure. I mean, they were just on that. I mean, you can get back to your point, but on that, I mean, people are still buying discs. I mean, the fact that the latest Sony PlayStation, they're selling many more units where they've got a disc drive, and part of the reason is that because you've still got to give presents to people. Otherwise, it's got to be something you can buy for your kids. Otherwise, you'll just be giving them money, and then Christmas is just going to be a period
with
for bank
CD-ROM
transfers.
With the CD.
Yeah, with the CD. Yeah, so kids are still using them.
A DVD.
Yeah.
Okay. Yeah,
but anyway, but your point is that this company was, but by and large, losing value though. So
and it's losing money, but apparently it wasn't losing as much money as the Wall Street mob thought. I mean, apparently it's still getting a reasonable cash flow, but of course the pandemic gave it a good kick in the proverbials. Which damaged its cash flow again because people weren't going out to buy anything, let alone games.
Yeah.
So that then meant that they were looking at it and saying, well, it's got to continue going down, so we'll buy it now and buy it back later at a cheaper price and then make a profit profiting the difference. And that's meant that they're exposed. There was short selling. And one thing which I haven't looked into this deeply enough to know whether it's true or false, but I saw that there were more shares short sold than there actually were in existence. Apparently.
130%. Yeah. Exactly. So they're completely overexposed themselves. So they deserved some sort of reaction to that, didn't they? So again, you could say, that is the market reacting. Somebody oversteps the mark, someone picks them up on it, and things come out in the wash.
Well, this is where it got to be real fun, because when you have people who've taken a position in a company which is correct. I mean, this is Keynes's comment about there's no point buying a share which you properly believe is going to be worth 40 in the near future when the market believes it's actually going to be worth 20 in the near future. Okay, so you call it a beauty contest where you're not trying to find the most beautiful woman or the person that most people think is the most beautiful person. You're trying to find the person that most people think other people will think is the most beautiful person. That was his madness of the third degree from the Economic Journal in 1937. So what you've got going on is precisely this sort of contest. And once the hedge funds had taken up this position expecting the share price to fall, then they were exposed to anything which might drive the share price higher. And this is one of those classic bull versus bears, where the bulls and bears don't care who's right. They care who wins. And if you find somebody who's locked into a short position and you believe you can bring enough buying volume to drive the price above the price they thought that they paid for by that stock, therefore they're losing money, then if you continue driving it, the higher you drive the price, the more they've got to lose. And then at some point, the people who've sold it short have to buy it, which adds to the price rise, because otherwise they get screwed having to pay an even higher price later.
Exactly. That's we certainly saw that happen. So hedge funds absolutely desperately trying to recover their positions by buying before it was even worse than it was already. But look, the regulator in the US is more concerned about Robinhood. I mean, they don't see anything wrong with what GameStop, the way the Reddit forum workers, subscribers all work together. It's not collusion. It's just sharing of information. They don't see any problem with that. What they're more concerned about is the retail platforms like the Robinhood app, which stopped the buys when they saw the price getting out of hand. Robinhood, they're saying, well, the question is, why did they do that? And, there's speculation that actually they just didn't have the liquidity to support it, because when somebody trades, you've got to have you've got to have a deposit to satisfy the clearinghouse that's going to deal with those trades, and you can't use the money that you've got from your retail investors. So if you get lots of people buying for the clearinghouse to accept the trades, you've got to have enough cash. I guess it's a bit like bank deposits, isn't it, really? And when you get a massive increase in the number of sales and you don't have the cash to support it, the deposit to support it, and the clearinghouse isn't going to support you. And then they go back and the clearinghouse says, well, okay, we're going to increase, when we see volatility, we're going to increase the deposit requirement, which they did, like massively, like tenfold. And so Robinhood just couldn't meet that requirement. They didn't have the liquidity, even though, of course, they deny it, which, of course, they would deny it because they don't want people to feel like they're not a platform of substance. So I think that's... So in the end, then you have to go back to the bigger players. So so here you have interesting. You've got an app that's starting up, trying to provide another retail platform, but by and large, it's not working because of scale. It's another example. Wall Street always wins.
Yeah, I mean, you need an enormous amount of money to play these games, and when you've got hedge funds that have got, work operating literally with trillions, some of them with trillions of dollars under management, then they can handle these calls on individual shares because they've already got different positions on a wide range of shares. But Robinhood apparently, I mean, I haven't even looked at the app. I must actually maybe sign up for the sheer fun of it and see how it works. But apparently, it basically says we don't charge you to trade, and therefore you have people coming in to take advantage of it who would be normally excluded by any trading and any charge for trading on being there in the first place. But equally, it means that they don't have a large capital base. So it was very easy. The success of the Robinhooders underdid Robinhood because Robinhood ran out of merry men, fundamentally. And then, of course, they were complaining about it and saying we're being shafted. But it's again, the whole thing is predicated on putting somebody in a position where they're going to be unable to fulfill their side of a bargain.
Well, I guess it's a bit like big banks versus small banks, isn't it? In that if you've got an equal number of stocks being bought and sold, then they don't need a big deposit for clearing houses. They just, it's a bit like if you've got a bank where you've got an equal number of people putting money into the bank as you have taking it out, then you don't need to go to Reserve Bank or other banks for funds. But the moment it all goes in one direction, which is what happened here, then you're in trouble. Whereas the bigger players obviously can manage that more because it's all a question of scale.
Yeah, but I think the people who managed to get those positions before Robinhood shut the door could have done very well from the combination of the price they bought in and the price they can sell out. The question is whether they actually go ahead and sell, whether they actually turn those paper profits into real profits, because one of the things I see people doing in the stock market all the time is they treat these things as if they're cash. And, I'm worth X because that's if I multiply the price share currently goes for by the number of shares that I own, that's what I'm worth. But you've got the very act of you trying to realise that is going to have an impact on the market if you're substantial. Yeah. And that's what's happening now.
Yeah, because you can't sell them all simultaneously for the one price. So, but how do you feel generally the idea that you've got companies like Robinhood and then you've got people like those subscribers on the Reddit forum? Is this the democratization of share trading, or is it a bit of a pipe dream? Is it good? Are they going to be successful? Is it a battle? Do they see it as clearly the Redditors see it as a battle between themselves and Wall Street. I'm not quite sure where Robinhood sits in this. They're probably just looking for an opportunity to get a slice of the pie. But is this generally all a step in the right direction?
No, I with the step in the right direction would be eliminating the dominance of speculation on the market, not dragging more people into it. And so from my point of view, this is exploiting a weakness in the system, and particularly doing it by having zero cost trades, so people can, there's no deposit requirement that slows down how much they can
lever what the money they've got. I have heard of quite a number of people getting into Robinhood and using their credit cards to get their initial cash level. That's what scares me, that sort of behaviour.
Yeah.
So the last thing I want to see is more financial speculation. I'm quite happy to see product speculation and funding of people who are doing product speculation, but this has got bugger all to do with that.
And you'd have to assume that a lot of people have got their fingers burnt, that they bought in because they've been, almost told to, or suggested it would be a good thing to buy into because, hey, we're going to take on the hedge funds. So they buy in, they see the prices rising and rising and rising. Obviously, some of those people will have been buying at the top, only to see it coming crashing down again.
Yeah, well, if you have somebody who's, say the price has gone from 100 to 1,000, which is the sort of price level that's in the realms of possibility of this one, and they buy in at the 1,000 expecting it to go to 2,000 and it goes back down to 900 again, they can have their capital completely wiped out. Then they get a margin call if they've got a margin account at all, and that wipes them out. So yes, there'll be quite a few people who thought they were going to make a fortune out of this that are getting creamed just because they bought in the wrong time in the trend when it was going to, they bought it as it was going up, and after they bought it goes down and they're wiped.
So hence the regulator is looking more at Robinhood than anything to do with Reddit. So although, you'd have to be looking at Reddit as well and thinking, because who knows, the people who are on that Reddit forum who said buy in, obviously those people bought in early and had everyone follow them. I mean, they may be saying we're taking on Wall Street, but actually they will have come out of this quite nicely.
Oh yeah, I mean, I've seen claims that people have been making $1 billion out of this sort of trade. I mean, it's more likely that people like Michael Berry, who took a position and rode with the wave as it went ahead, that did it rather than the Main Street people. But quite a few Main Street people would have turned 10,000 into 100 by the process. And then, of course, you'd ask more people to come in, and if it works, if more people come in, and what do we call that? We call that a Ponzi scheme.
Yeah. Well, we do.
So,
but how do you stop that happening then? I mean, because it's difficult to prove, isn't it? I mean, you can go back to the source of all of this, and the guy behind it who's now sitting pretty would say, no. My motive was to take on the hedge funds because I knew that they'd have a margin squeeze out of all of this. They'd have a short squeeze out of all of this. And that happened. So they got that. It's just a coincidence that alongside that, I seem to have bought a very nice house out of all of this.
Yeah, I mean, a Ponzi scheme, literally speaking, has somebody in the middle who's manipulating either end and promising huge returns, which are all financed by giving the next person in half the deposit given by the previous person. So that's not what's going on here. But what you have got is something that only works while that price continues going in one direction. And the only way to make sure it keeps going in one direction is to continue piling in. Now, of course, the danger that brings is that if all the short sellers, who are the genuine short sellers, are in there thinking the share price was going to go down, so all your Merrill Lynches and so on have actually been forced into buying in instead and closing out their short position, then you're going to get to a point where the entire basis for the high valuation of the stock is the people who bought in to squeeze at short sellers, but there are none left. So as soon as people think, well, let's actually now try to realise the price I've got, the gain I've made out of this, then they're selling into a market where there are the only buyers are more people who believe that it's going to continue going up. Now, if it starts going down, there are no buyers at all, and you get a total plunge, a total collapse. And that's what we've seen. It hasn't gone all the way down, but it's happened several times in the dynamic so far. I'm
having difficulty sort of imagining where the brain power behind all of this was thinking that these prices could go up and be sustained. That seems to be in the question. Is that the second part of the equation. The first part is if we can push the price up, then it's going to hurt the hedge funds who are betting on the price going down because they're going to have to recover their positions and it can destroy them. But no one seems to have, they don't seem to have thought about the second part of that. Is once it's aspired to these dizzying heights, what happens next? The price is obviously going to come.
Maybe you and I haven't been following it closely enough to know on that front. But I mean, there's some people who are part of the Patreon audience out there who are like, hey, Craig might have a better idea.
Yeah, what was part B to this, Craig? Tell us.
Well, part B could well be that they knew this was going to happen at some point, and part of the strategy, as well as buying in, what you're trying to do is force the short sellers to buy in a short squeeze, and there are two elements to the short squeeze of the shares and the short squeeze with options as well. And then at one point you realise, okay, you've taken them out, now get the hell out of there. So there has to be an exit strategy as well as an entrance strategy. And I would like to hear from Craig and a few others who do this.
What the exit strategy was. Yeah.
Well, whether there was one, and whether it was widely discussed, and whether people who came in afterwards just didn't realise there was an exit strategy as well as an entrance one, and they came in after everybody else had gone for the exits.
Yeah, well, it was started at 88. It finished around 470 to 500. So if you bought at 88 and then all of a sudden...
factor of 5.
Yeah, factor of 5. Or more to the point, if you bought at 400 and and then it went up to 500, and now it's getting down to 100. How do you account for your losses? What do you do next?
Yeah. So that's the thing, and that's one reason one legitimate reason to have limits and require people to be what they call sophisticated investors, because they're trying to keep people out who are doing the bellboy thing of throwing their life savings at a speculative stock.
Yeah, so that was going to be my next question. How do you, because obviously the regulator is interested in this because they've got to try and figure out how you handle this sort of thing. I mean, it's easy for the hedge funds and Wall Street because they're already saying it. You know, we're going to use artificial intelligence or tools that are going to enable us to monitor all of these forums and, you know, look for keywords it's just another part of, I mean, they're looking at everything, aren't they? So it's just something else they look at when they're determining what they do with their money. But the little guy who's using these apps, how are they protected? Almost protected, and they're going to hate. I'm going to get in trouble for saying this, but they need help being protected from themselves, don't they? And what does the SEC do about that?
Well, there are some people in there, and again, this is going on feedback from Craig and others in a couple of discussions I have off Patreon. There are some very, very bright people involved in that Reddit discussion, and they really did know what they were doing, and they're looking for a whole range of areas where they can take on short sellers and do them in, given the market volume and so on. But there are other people who see it, and there's no way that I believe that Robinhood discerns between people who fit into that category and others who think, I've got to pay next month's house insurance or house mortgage I can't afford to, or I'll take a bit of money in the credit card, put it in Reddit, ride the wave and come out and pay my mortgage, and then bang, it goes the opposite direction and they've got to sell the car as well as sell the house. And we have seen, I believe, I don't know, I won't say it out loud, but a couple of fairly fateful events may have come out of people who bought in at the wrong time on this naive investor side of things. So it is going to cause the regulators to say, well, we have to put some limits on this stuff, because the fact that Robinhood doesn't require people to pay money to make a trade has made this much, much more widespread than it would otherwise be.
Well, the restraint on Robinhood has been the extent of their own liquidity, hasn't it? That's been I guess that's the ultimate constraint. But we do know over this last year there has been a big increase generally in retail investors in the share markets in America. The last time we saw it happening to that extent was when everyone got into the .com companies. There's a huge amount of naivety there. I was involved in one of them. We've got a bit of time. I'll tell you about it in a second. But are we seeing the same thing happening again? And could that mean we have another .com bomb?
Well, I mean, this is
on a broader context, obviously.
I think we're talking about the retail investors driving up the market. The real speculator that's driving up the market is the Federal Reserve and its companions around the world with quantitative easing, because the whole objective of QE, and you can literally quote Bernanke on this, was to drive up share prices to give people a wealth effect out of which they'd consume more and that'd stimulate the economy. Yeah. So I summarised that in the first line of the Economics New Manifesto. It was a theory about how we can get the economy going again by making the wealthy wealthier.
Yeah, well, so, Friedman was very much behind that, wasn't he? In his thinking, it's and a lot of that they are the retail investors, because we've seen this big increase in savings in this K-shaped recovery that we've seen, where you've either kept your job and I'm wondering what you're going to spend your money on, so you've got a bit of savings, or you're absolutely destitute. Those people on the upward side of the K have saved a great deal and are wondering what to do with their money, so they are putting it into shares. And so it's not just quantitative easing. It's just that it's also the fact that there's increased savings because people haven't got anything to spend their money on.
But it's also whether, I mean, a lot of that increase in valuation has come from with QE, you're buying the bonds off the financial sector. The financial sector gets additional reserves that don't earn any income, so they're going to try to put it into income-earning assets, and that's what's making people literally wealthier if you own shares. So we've got a market which has been overvalued by pretty much what used to be called the Greenspan put, the promise that the central banks will make sure shares don't fall. So therefore, the most sensible thing is to pile into shares. And now we're seeing levels of share prices, which I know they're higher in terms of the capital, the cyclically adjusted price to earnings ratio of Schiller, higher than 1929, higher than 2007. The only period that they're not higher than is the 2000 .com bubble. So that's the overall milieu in which retail investors have jumped in through Robinhood as well. And it makes for an incredibly volatile system. It could mean that, some of the flash crash stuff we saw beforehand is going to happen again, not just at the large hedge fund level, but also at the level of retail speculators.
So it is all just that there's obviously too much demand, as you say, from banks that have now got to spend money in other ways because they're not holding bonds, which were seen as a secure form of income. So they've got to look for more volatility. So they go for shares, and then those retail investors are also going for shares. So collectively, they're all pushing the price up. I mean, if there was just something else, there's property. Which is also going up. But if there was something else that people could do with their money rather than putting it into shares and property. And look, I know the pressure because my wife is perpetually telling me that we need to do more to get a passive income. And I hate that expression. We don't come to blows over it because I tend to walk out the room.
She's bigger than you are. Yeah, okay.
Well, she's not bigger than I am, but she's...
don't repeat that to her. I mean, she's stronger than you. Okay?
What are you saying about my wife?
I know.
But no, this idea of passive income, to me, I don't know. I'm North of England lad, and I get the idea that you should work for a living rather than just having money flowing in. But I mean, that is the mentality. And
make your money work for you type nonsense. Yeah. And that's what leads to this. Yeah.
Yeah, that's exactly what leads to this. But if there's somewhere else where people could put the money, which wasn't shares and isn't property, and might actually be helping the planet as well, for example, I mean, what would that be?
Well, that's one reason that I would like to see us harnessing crowdfunding for entrepreneurs in the future, because I've learned a lot. My first indulgence in crowdfunding was to raise money for Minsky back when I got shafted by the University of Western Sydney and couldn't get government research funding money anymore. Not that I ever had, but I did the Kickstarter campaign for Minsky back in 2012, and 78,000 raised that way, but about 100,000 all up, and that to me was the wisdom of crowds. And I've now supported, I think, about 30 or 40 different crowdfunding ventures. Maybe 3 or 4 have actually come through with some solid product at the end. I'm happy to indulge.
That's benevolence. I mean, people aren't necessarily...
That's benevolent, yeah. But I would like to have people worry about the government wasting money and the government picking winners and stuff like that. Why not just let the government have the money creation capability and give people money that has to be used on crowdfunding? Otherwise, it doesn't.
Right. Separate issue though. We're talking about people who've got a bit of cash and want to hang on to that. Don't know what to do with it. Basically, they want to hang on to it. It's not doing anything in a bank, so they put it into shares because they think they're going to see a better return from it. But if you were to say, well, okay, you're probably not going to get a better return, it is a bit risky. What else do you do with it? So, I mean, for example, I've put mine into premium bonds because it gives
premium
me
bonds.
So premium bonds in the UK are it's basically managed by by either the central bank or the Treasury, anyway, whoever. Basically, it's like government bonds in effect, but they don't pay any interest. You can take them back whenever you want, but rather than paying interest, they have a draw every month, and you could win.
Oh, you mentioned that, yeah.
You could win £1 million, perhaps. It hasn't happened so far, but it doesn't matter because I can get the money back. So rather than sitting anywhere, it saves me gambling. It's the closest I get to gambling. but it's somewhere else for me to park my money. But there's a lack of vehicles for people, and this is the problem, isn't it? What do you do with your cash where your money is safe, or relatively safe? That's an alternative to driving up the stock market or driving up property prices, and that is the problem, isn't it? There's nowhere to go.
Well, that's the trouble. There shouldn't be somewhere to go.
But
in terms of if income, if you want to make an income without risking it, then there should be no such thing. And there is no such thing. You've got to take some sort of risk, but it's people trying to find some way of getting a positive return out of their stock of money.
Right. So what we should be doing is getting people to invest in new ventures rather than.
Which is why I come back to the some way of letting people become not short squeezers and part of the whole bulls and bear hassles on the stock market, but finding a way that they can pool money into entrepreneurial ventures that actually come into something worthwhile. And in that case, even if it doesn't come through, you sort of think, well, I've still helped. There's been some research done that may be beneficial further down the track. So I'm hoping that's what I would rather see people doing. And then that you might not be getting your money back. You may do well if you happen to pick the next Elon Musk, then you may do well out of that. But overall, it's not something people are trying to get a huge amount of profit for just simply speculating and gambling, which is what the stock market really amounts to. So
people who don't know what to do often do, because it is a full-time job trying to understand the stock market and try and pick winners and losers anyway. They tend to manage funds, and you'd argue, I suspect, that if you're putting money into managed funds, then you're still driving the share market higher than perhaps it would be otherwise, and you're giving more money to Wall Street and the finance sector, or to the city, because the finance sector is clipping the ticket on all those trades, and the finance sector's got enough money as it is. Thank you very much.
Yeah. And I've seen similar comments about this particular bubble. The big winners, some of the retailers have done very well, but the big winners were people in the Michael Berrys of the world who'd taken a similar position against the short sellers and rode the wave with a lot more money and probably sold out long before the retail investors did. So again, we're having a discussion about the bellhop's share recommendations.
Yeah. All right. So it's interesting that the conclusion seems to be, well, apart from the fact that we do need to look at the structure of how people invest and try and drive people more to the primary market than the secondary market. Right? And I was surprised by your point that apps like Robinhood are not necessarily a good thing, because it just drives more people into that market, and people who perhaps don't really know what they're doing, so they stand to lose more.
And it's a waste of brain power. I mean, gambling over whether a company which is going to fold, whether you can screw people who are betting on it folding in the process and make money out of it, and you get a nice little adrenaline hit along with a large amount of money. I just see it ultimately as a very wasteful use of the human mind.
Yeah, and these are smart people as well, aren't they, who are tied up in this? I mean, that is a really good point. Maybe if they were trying to tackle problems like how we deal with climate change and some of the bigger issues for mankind, maybe we could have more positive outcomes. Good point to leave it on. Good to talk, Steve.
Good. Yep.
Catch you again next week.
Yep.
Okay. Now, look, next week we are going to look at degrowth. This is going to be an interesting one. We've got used to degrowth over the last year, and perhaps we need to get used to more of it if we are to tackle the problems of climate change. Do we just need to keep on behaving like we have over the last year to solve the problem? We'll look at that next week on the Debunking Economics podcast with Professor Steve Keen. I'll be back then too. I'm Phil Dobbie. Thanks for listening. See you next week. If you've enjoyed this podcast, then please share it with your friends, like it on YouTube, and subscribe to this channel.